Hey, welcome to our journal entry, T accounts and trial balance lecture video for this module 1. I do want to point out, I try to put this on all of my notes, that these are actually my notes that I would have used in a classroom. So they're not going to be grammatically correct. They're not going to be, in a paper format. So just note that if there's, these are used for my notes, and I'm giving you access, and hopefully you can you'll learn something from them, but they're not meant to be in proper final etiquette, like I was going to be publishing them. All right, so items covered in this document. We're going to look at payroll taxes, who pays which tax. That's going to be these first two. And whenever you see the abbreviation EE, I mean that as employee. And then an ER, if I ever have that, that is employer. Most of the time I try to go ahead and spell it out, but sometimes in my notes when I was going through making them, I will just put EE, and I know that means employee. We're then going to jump into, once we determine what the payroll taxes are, how do we journalize those kind of behind the scenes for the bookkeeping part, and put those into a T account to keep track of our ongoing balance. And then finally, how do we prepare a trial balance to let anybody else know what our accounts are, what balances are, so they can pay any of the liabilities that we have and know how much expenses we have, all of that good stuff. All right, so what you'll want to do is over here, if you haven't found these notes yet, how you're going to do that is you're going to come over here to the modules, and then come down here to in module 1. Come down to the learning activities. That's where you're going to find all of the items that you need to succeed in each module. I've already had the first video. Hopefully you've taken the time to go through that, where we discuss the welcome document. We're now going to be here in this third item, module 1, journal entries. You're going to go through the overview notes on your own. These are overview of the entire payroll system. There's no need for me to really walk through those. You can read through those yourself. They are part of the quiz and the assignment. So make sure you definitely know those and you have that and have gone through that, but I will not have a separate video covering that. We're also going to make sure you pull up the T accounts. We're going to have that going on as well to help keep track of account balances, to then be able to prepare a trial balance. All right. I'm going to, at this point, get rid of this screen, and eventually we're going to pull in another, an Excel screen, the T account sheet. But first, who pays which payroll taxes? This is important items you need to know. And by the end of this class, you should definitely have them memorized, but you want to work on memorizing them right now, because I won't necessarily give them to you in each individual problem that we have come up. All right, so the first one that you need to memorize is the Social Security. So there are potentially 5 taxes that include federal and state taxes. They could be more, could be a little less, because not every state has county withholdings. And not even every state has state withholdings, as we'll find out later in the semester. But these are the 5 that are typical for Indiana. So we've got Social Security. You need to memorize the cap, not the cap, but the percentage, 6.2%. That's how much of the taxes that are the wages that are taxable. That's how much you're taxed at, 6.2%. And the cap for the tax year 2021, and that's what we're going to be using throughout this entire class, no matter which semester you're in. We're going to use the 2021 cap of $142,800. Now, what that means is that is your capped wages, not how much you have put into Social Security, because that can be a confusing point to some. So once your wages for the year, if you're pretty well off, once your wages hit $142,800, you are no longer taxed on Social Security. The tax will go away until you start the next year, the next calendar year. We're going to cover that in a lot more detail in module 3, but it is something that we will begin to use right now when we're doing journal entries coming up. All right, Medicare, the second tax. These two go together a lot of times when people are in payroll. They'll talk about FICA taxes, and we're going to, again, cover that in Module 3. But some people will lump these together and call them the FICA taxes, and they'll lump the two percentages together and add them up. For this class, we're going to keep them separate because they're taxed a little bit differently because of the cap. Note that Medicare has a lower percentage, and it doesn't have a cap. So every taxable dollar that you earn will be taxed at least 1.45%. Now, there is a caveat there that we'll go through in Module 3, where you could be taxed more if you're in a really high income. All right, federal withholdings. So these are the taxes that go towards the federal government to help keep the federal government going. These are covered in a lot more detail when we get to Module 5, and it's going to depend on your marital status and how many dependents you have, as well as if your spouse or you have a second job. Those kind of items are going to be factored in to figure your federal withholdings. Until we get to Module 5, I'm going to be giving you the federal withholdings for each employee. I'll just give you a straight amount. It was $70, for example. And then you'll just use that. Once we get to Module 5, you will then begin to calculate what it actually is and how you would do that in the real world. State withholdings. For Indiana, we're gonna base everything off of Indiana. And for Indiana, the state tax rate is 3.23%. And that's really pretty close to what you're gonna have taken out of your payroll checks. So that's what we're gonna use for this class, is 3.23%. And that is one that you will need to memorize along with the Medicare and Social Security amounts, because those I will not give you. You'll just need to know them. The county withholdings, we're going to go through this in a lot more detail when we get to Module 5 and 6. But each county in Indiana is, you have a different tax. You have a different amount that it could be taxed. And usually it's anywhere from about 1% up to about 2.5% on average. There are a few outliers either way, but those are the typical. So an extra 1 to 2.5% would go to each county. And that's going to pay for your county roads, your county courthouse, the county city building. Those kind of things are going to be covered in those taxes. And then you can have other items that are withheld from your check. And these also are part of things that are taken out, the money that are taken out to go to medical insurance premiums, your retirement account. We'll talk about flexible spending, and then if you have any other garnishments. Now, those are the taxes that are taken out for the employee. The employer has different taxes that they have to pay, has a different set of taxes. Now, some of them are going to be the same as the employee. They're just having to put more into it, into the pot. Instead of just the employee's portion, they're having to put their own portion in. And then a few of them, there are a few different taxes that are taken out as well. All right, so the employer has 4 primary taxes that they have to pay each payroll. The first 2 are going to be identical to what the employee paid here. So if the employee paid, it came out to be, let's say, $40 in Social Security tax, then the employer is going to have to chip in an additional $40 and pay that into the Social Security. They're going to do the same thing for Medicare. Whatever the employee paid, they're going to chip in an additional identical amount. Therefore, what that means is also if the employee is a very wealthy employee and they make a lot of money, if the employee goes over the cap, so will this employer. They will no longer pay into Social Security either. Now, the 2 new taxes that the employer has to pay that the employee, at least in Indiana, does not, are FUTA and SUTA. And what these stand for, and we're going to get these in a lot more detail when we get to Module 7. FUTA is the Federal Unemployment Tax Act. Again, that's Federal Unemployment Tax Act. This is a very low percentage, 0.6%, or as a decimal, 0.006. And it's even capped at a very low wage amount. So once the employee has wages over 7,000, which most people will if they have a full-time position, of course, they would definitely hit over 7,000. Then the employer will no longer be taxed on FUTA taxes once the employee hits that wage level. And we're going to have some examples of that coming up. SUTA, each state has their own rules and rates. So this is just the same except for state Unemployment Tax Act. Your rate, I will have to give this to you for each problem because it's different for each employer. Each employer is rated based on how many people they lay off and the employees that have to dip into this fund for unemployment. So if you've ever collected unemployment, that's where your unemployment comes from, is from employers putting it into this fund. So if an employer has a lot of prior employees dipping out of this fund, then they should be paying more into it, and they do. Note for Indiana, the cap is at 9,500, so just a little bit over the FUTA cap. And then some other items that the employer may also pay in is if they match, say, your 401k, that's going to be an additional expense to them. If they, and most of them do, pay into your medical premiums insurance, that's going to be an extra expense to them as well. All right, so that covers the first part, payroll taxes. Now, once we figure out the tax, let's see how we actually journalize these and put them into T accounts. If you've taken Accounting 101, hopefully this next section is complete review, or at the very least, a review to help refresh your skills of what journal entries are, how to do them, what a debit and credit is. If you've never had Accounting 101, then this is going to be probably the hardest part of this lecture, is just learning what is a journal entry and how do I do it. All right, so as we get into journal entries, here is the primary, what you would call the accounting equation. So there's an equal sign that makes it an equation. Everything over here, which is just the assets, whatever this number is, has to equal whatever all of these total up to, all of these 4 items. And so that's, just kind of keep that in mind. These are known as our T accounts. And at this point, I'm going to bring over this is the T account item that I made for you. And you can see it has the equation up here at the top. Same thing, it looks just like this. Our assets, and then notice the plus minus. So that means anything on the plus side is going to increase that account. And then correspondingly, everything on the minus side is going to decrease that account. And you'll see here on the very first one, I have a no underneath the minus. That's because you can't have your very first item be a negative. You can't have $0 in your cash and then spend money. You don't have the money to spend. Think of it as, it's easiest just to think of it as money in your hand. If I don't have any in here, I can't go buy something. So your first entry always has to be a plus to get money in your hand. Then you can start paying it out. And I've got it even set up to where if you start putting in amounts, let's say you had $400, I've got it so it will total up for you. You don't even have to do that. And it will total up here to see if your equation balances. So I've got it set up real nice and neat for you. Now, before we get into the rest of this, I want to make 2 notes here about what a debit is and what a credit is, because we're going to be talking a lot about these 2 terms. Basically, think of it as a debit as the left side of the T account. So anything over here is a debit. Now, for an asset, a debit happens to be a plus, but that's not always the case, because if we come over here to a liability, something that you owe, a debit on the left side is a subtraction. Whenever you debit an account, you're lowering your liability on what you owe. Just the opposite then is on the right side of the account is called a credit. A credit to an asset is a minus. Anything on the right side is going to reduce your asset, or in this case, cash. Anything on the right side on a liability or owner's equity, or even if you make money in your business, revenue, anything over on the right side is a plus. The credit is a plus. So it's not, you can't think of credit as being a plus or a minus, or a debit as being a plus or minus, just because it can be either. Just think of debit as whatever is on the left side of the T account or the journal entry, and a credit is on the right side of the T account or journal entry. Now, how I have your template set up is I only have the most common payroll items listed. So if you were doing this for a normal accounting 101 class, you would have a lot more assets. You would have things like account receivables. You would have things that like equipment or supplies, lots of things that you can own. Usually it's things that you can touch. And then for liabilities, I've got a couple examples here, but I've got a lot of them over here. These are all the normal payroll liabilities that you're going to come across. And you can see that there's quite a few. You got your normal taxes, and then you got items down here where I started just to show what it would look like. It's going to look the same, just not going to be a tax. Medical premiums, your medical insurance premiums, you owe, let's say Aflac, if that's the company you go through, or Blue Cross Blue Shield, if that's the company that the employer goes through. They're going to start adding up what they owe to get their employees covered. And then they got to pay off their bills. We're going to do a lot of examples like that. And so every time you have, let's say, some money put into the Social Security account, I've got it set up where it's going to add it up for you, your total. And then it's going to put it up here in your total. This is the right-hand side of the equation, so I put those in green. And then the blue is your left-hand side. And then let's say you make a payment to the Social Security. You write a check for what's due. And let's say you paid the $60. I've got it set up to where your balance will now be zero, because you are subtracting anything on this side. This side is your plus. So we owe 60. Now we've paid it off. So we don't. So we're going to see how that really works when we do a journal entry here in just a few minutes. But I wanted to show you that the T accounts are set up. And when we're doing the T accounts here, I've got our final thing up here. This one is a total of everything on the right side. So all of your greens are going to total this. So if I had $60 here, and then I had, let's say, 120 over here, it's going to have the 60 and the 120, but up here it's going to be the total. And that blue there better equal whatever's in this blue square. So this blue square, if we did everything right, would have $180 in it, because both sides of the equation have to equal, just like in any other math equation. All right, when we're doing a journal entry, and this is the second one I have, the second tab here, just what a template journal will look like, and then you'll start filling them in. We'll have a date. Let's say it's 1-31 of 2021, or 2022. Just make something up. And we would always put our debit account first. So it would be something like this, say wages expense. And then whatever that amount is that we figure up, we would put it over here in the debit column. And then it tells us credits are always listed last, and they're indented. So instead of trying to remember to indented means kind of like, when you do a paragraph, when you're writing up a paper, you would tab over. Well, in this one, it's just sometimes easier just to go ahead and tab a whole column over. So we would put our credits here next. So we would have any other credits that we would have listed here. Say it was Social Security payable as our first credit. And we would list out of the 200, how much is going to go to Social Security. Say it was $10. Well, once we got all the way down to our last credit, because we may only have one debit, but we could have 6 credits. It doesn't matter how many you have of each. What matters is that they add up to the same amount. So the 200, if that's the only one over here, then this side over here, when you add everything, better be 200. Doesn't matter how many it takes to get there, just that they are the same. And then whenever after we're done journalizing them, we put their numbers over here. So like the wage expense, I would say we had $200 from that journal entry, was 200 on the debit side. So I would put 200 here on the debit because it's the left. And then I would have came over and I just had put in that it was $10 in Social Security payable. And that's how we would start doing the journal entries and T accounts. They go together. So once you do one, the second, the T accounts should be fairly easy. All right, let's actually go through a little example. And you're going to begin to see how this works. What I'm going to do is we're going to slowly go through these, and I'm going to put them over here into the T accounts, so you can see what that would look like as well. All right, so again, this is just a practice example just to show what a journal entry looks like in full. And then we're going to do another practice or two to see if you've really got it down. All right, so each journal entry in payroll, and this goes back up to our notes, each journal entry is going to have two, because we're going to do a journal entry for whatever the employee has taken out of their check. And then we're going to do a journal entry for whatever the employer has to pay in addition. So remember, the employer has 4 extra taxes that they have to pay. I mean, eventually the employer pays all the taxes on, but 4 taxes come out of the employer's pocket that the employee doesn't even know about. So you didn't even know that the employer, unless you've taken an accounting class before, that the employer actually pays additional taxes that don't even come out of your check. All right, so that's what we're going to do. We're going to have 2 journal entries. So I'm always going to give you some opening information that you have to have. I'm going to tell you which payroll this is that the employee has gotten to, because that's going to be important for those CAP purposes. And then I'm going to give you how much they earned, and then a few of the items that you don't have memorized because they would change per employee or per company. Everything else, you've got to remember what they are from the notes up above and what the percentage is. So like Social Security. Note, I don't have anything about Social Security on here, but you need to remember to do it. All right, let's jump in. Let's see the employee's journal entry. When you always start out a journal entry, hopefully you remember this from your Accounting 101, start with your debit, and we're usually just going to have one debit for each of our payroll journal entries. Wage expense. That's how much the employee has earned for this pay. Doesn't mean that definitely is not going to be what they're paid. That's what they've earned. So if they earn, let's say $10 an hour, and that would be 100 hours for this pay period. Whatever, if it's a 2-week pay period, or maybe it's a month pay period, whatever it is. So $10 an hour, maybe it was $20 an hour. That would be a little bit maybe more realistic. You could get up, oh, that's a big calculator. Get up our calculator, and we could see that if they had $20 an hour and they worked 50 hours, that's the $1,000. Now what we have to do is go through and credit each of the taxes that are taken out of the employee's check, including anything else that's taken out of their check. Now, I don't tell you anything else that's taken out of their check, but I would tell you if they had 401k taken out, which is their retirement money, if they had money put into their medical premiums, insurance, and then any of those other items, we would need to note that here. All right, so we've got our wage expense. Now we're going to start basically going up here and going through all these. Okay? Each of the item for the employee. So let's do that. We got our wage expense. The first thing we come to is Social Security. That is taxed at 6.2%. So that needs to be taken out of the check. The employee will not get paid that. And that's going to go into a separate fund. So all I need to do first off is figure out, am I over the cap? Okay, let's go back up here. The cap is 142,800. Once the employee hits that, if they ever do for that year, most employees won't, of course. If they do, then they stop paying Social Security. This person is nowhere near that. They've only earned 6,700 so far as of March 15th. So now we're into the next payroll. They've earned an additional 1,000, nowhere near 142,800. So we just take the full 1,000 and multiply it by the percentage, which is 6.2%. As a decimal, let's just move it 2 places. So 0.062. Now, as we're doing this, we could go ahead and we might as well, let's start putting these into our T accounts. So wage expenses are always on the far right. We had $1,000 and we could put this in as, this is our March 15th payroll. So the date would be 3/15. And then on 3-15, we had Social Security of $62. Notice I put here, no. Your first, just like with cash, your first entry can't be a negative. Same with Social Security payable. You can't pay off taxes if you don't even owe anything. You can't have a negative. You can't pay off taxes when they're not owed. That would be prepaying, and then that's called something else in accounting. That's not a liability, is when you actually owe something. So you can't pay on something if you don't actually owe it. Now we do. Now we owe $62. The company does, because they've taken it out of the employee's check. All right. Our second item, if you go back up, our next one is the Medicare. Medicare, there is no cap. All the amount that we earn is taxed at the full 1.45%. So 1,000 times 1.45 is 1,450. So I put in 1,450. All the while it's adding up here. Right now we haven't put anything over here, but of course we'll have to have something most likely. It's not necessary as long as if these would actually total up to be a 0, because right now notice it's negative because the expenses are a subtraction. So we've got that 70 some dollars minus 1,000. So we're in the negative right now, but it'll all even out here very quickly. Also, I forgot we have this. We have assumed starting balances of 5,000 in each. Oh, so I forgot to do that. Let's go ahead and put those in right now. We're going to put in here opening. These are our opening balances. And we had 5,000, it says, in cash to start up the business. And that came from the owner, which is known as common stock or capital. And that would be our opening balance. Okay, now that's going to help us with our total up here. It won't be a negative anymore. I don't like to see negative up there. All right, so now we're all caught up. Okay, so we've done 2 of the taxes so far. Back up here. We've done Social Security and we've done Medicare. We're ready for the federal withholdings. Notice this one, I'm going to have to actually give it to you because we don't cover it until at least module 5. So on this one, I tell us, assume that federal withholding is 5% of your wages. Okay, so if that's easy to do, 5% of 1,000 is $50. So the employer is taking $50 out of the employee's check. And then correspondingly now the employer owes $50 for federal income taxes. Normal Indiana rate, remember that's 3.23%. So we take our 1,000, no cap, 3.23%. So we've got 3230. And then the last one that the employee has taken out, especially for the state of Indiana, and I have to give this to you, or I have to at least tell you the county so you can look it up, and I won't do that until we get to at least module 5. The county tax rate, I tell us, is 2%. So 2% of the 1,000 says $20 has to be taken out of the employee's check. to go towards county government. Now, all of the taxes have been taken out, and it doesn't note anything in here about anything else being taken out, like 401k or medical insurance. So the final thing left to get both sides, because both sides always have to balance. Because basically what I'm doing here is what I would be doing over here. I have my wages expense, and then I would be listing all of my credits. And right now, if you would add up all of these credits, they're nowhere near the 1,000. Well, that's because the employee hasn't been paid yet. That's our final item. We've got to pay the employee. Now for this final credit, it's going to be, the amount is going to be whatever's left. So all you really need to do is just take your calculator, take the 1,000, and then start subtracting out all of the taxes. Whatever's left, that will be what you pay, is what you still owe the employee. So let's go through and do that. I subtracted every one of those, 821.20. That's what we're actually going to pay the employee. Or we could call it wages payable if we're not going to pay them quite yet. Maybe we pay them a week later. And a lot of companies do that. If they do it like a week later, they're going to call it wages payable, saying we owe you $821.20. Or if they pay them right now, they can just call it cash, and they're going to write them a check for $821.20. Now, if you add up both sides, they're 1,000. We come over here and put in the final amount on 315. It's on the credit side because we're actually paying out to our employee, $821.20. Now, if we're all done with the journal entry, we should be able to look up here and see what this side of the equation, everything over here equals 4178, because that's all we had, just that one account. And then everything over here, when you add all of them up and then subtract out your expenses, and that's what I have up here, should be the same as your assets. And it is. It's 4178.80. And this one is 4178.80. So I know that I have put in everything correctly that I have. I've at least matched it up. It doesn't mean that these are the correct numbers, but at least I've matched them up correctly. So that's journal entry number one. Remember, there's 2 journal entries. Now, just to kind of give you an idea, because you see all these numbers and they start to ramble together and you're like, what does all that mean? Well, if you really wanted to see how much taxes is the employee paying out of their paycheck, it's quite a bit. Almost 18% of their pay is going to something other than their pocket. And that's quite a bit. And that's on the really low side, because then you start taking out items like insurance and money that's going into your 401k, which you won't see for years and years, but it's still good. You still need to do it. All those other items that are taken out of your paycheck, it starts adding up real fast. But the key thing is to look at, you'll almost never see this money, except you could argue you'll see your Social Security, and that's true. All right, now let's do journal entry number 2. So we did the employee side. Now we're going to look at the employer side. What do they also have to pay and put into these T accounts that they owe? So we got the 4 taxes here. The first 2 are going to be identical to the employee. And then the last 2, we're going to have to start looking at caps, because the cap is really low. So that's going to come into play, and we're going to see how that works. The cap works the same no matter which cap we're looking at, FUTA, SUTA, or up here with Social Security. They all work the same. So once you know how to do one, you can do any of them. Okay, so we're ready for this journal entry number 2. This journal entry number 2, we're going to start out. And the weird thing about journal entry number 2 is you're going to have your debit, but you're not going to actually know what it is. So we've got to think of this as like being XYZ, unknown. We don't know what it is, because the payroll tax expense is basically going to be whatever your 4 taxes line up to be, whatever they add up to be, that then it will be, we will fill this in last. So the first thing, we don't know what this, I've already done it, so I know that it's 118.30, but just starting out, I wouldn't have known that. I would have had to gone through what we're going to do now. Start listing all of the items that the employer has to pay into. The first one, remember, is Social Security, and they're going to do identical to the employee. So they're going to go in and put an extra $62 in. So they come over to their T account, and I'm going to put in here the same date, 3/15, because they happen at the same time, an extra $62. So now when it's time to pay Social Security, we owe $124. Because we owe what the employee had to pay in, and then we owe an extra 62. Same thing goes with Medicare. Medicare, we're going to match whatever the employee had to pay. So we've got our 3/15 date. When it's time to pay, we owe $14.50. Okay, now is where we get into the harder part, because this is where caps come into play. Let's go back up and review real quick the FUTA. FUTA, 0.6%. As a decimal, it's very, very small. Just move the decimal 2 spots, 1, 2, so it's 0.006. And we're capped at 7,000 in wages. All right, so if we look at my initial information, our prior earnings were at 6,700. That's how much we've made up into this paycheck. We just earned an additional 1,000. So when I add these two together, they take me over the cap. And whenever you get close to the cap, you always want to check that. You want to do what I call step 1. Step 1 is determine yes or no, are you over the cap? So if you were, and if your answer was no, let's say you added these up and it was only 6,900, then you just go on as normal. You would just take the full 1,000 and multiply it by the percentage. But if your answer is yes, it does go over the cap. So when you add up these two, 77 is over the 7,000. We then have to go to step 2, our final step. Step 2 says, okay, forget that this even is there. Just ignore it. All you did for step 1 is just use that number to answer a yes or no question. Are you over the cap? Once you do that, you forget step 1 exists. You come down to step 2 because we answered yes. We find the cap. What is the cap amount? 7,000. And then we subtract where were we at before we started this pay. And it told us in the problem, we were at 6,700. And then we just subtract the 2. No, I do not use the 7,700. That is the biggest item where so many people, students come off and get the answer wrong. They try to plug this number in somewhere and you don't want to do that. All you got to do is take the cap minus where are you at. So that tells us how much dollars are left until you get to the cap, 300. So when I do the journal entry, instead of taking 1,000 times 0.006, I just take whatever's left to get me to the cap, the 300. So I can put that into my T account down here that I owe $1.80. SUTA, we do the same thing for cap purposes. Because FUTA and SUTA are pretty close, we can just look at step 1. Total wages, 7,700. That is not over the cap. Because remember, SUTA for Indiana, the cap is 9,500. And that's what we're going to use in this class. 9,500, when we add those two together, this is not over 9,500. So we would answer no, it's not over the cap. So we do not do step 2. We just do the full $1,000. 1,000 times, and then I have to give you the percentage. The percentage here, SUTA, 4%. 1,000 at 4% is $40. Now we can go in and answer this unknown. If we add up these 4 items, we got the 62, the 14.50, the $1.80, and the 40. That's going to give us our debit amount. That will make everything balance. Our debits are going to equal our credits. So all of my payroll expenses, payroll tax expenses, are an additional $118. So I come over here to my payroll tax expense, $118.30. Now you can see I can check this again. This time it came out to be the same because all of my answers were over here on the right side of the equation. Note, I didn't put anything over here on the left side. But even so, it came out the same. I still got 41.78 here. And because I did the correct debit and credits, I still have 41.78 on the right side of the equation. They zeroed each other out. This was a big old negative in the expenses because it's a subtraction. And then all of these guys were added up to offset it. So that is journal entry number 2. Now, what I want to show you, because after we do a journal entry, we start owing the IRS money. We owe the IRS $124 in Social Security. And then anything else down in this column, we owe as well. All of these items we owe that we're eventually going to have to pay. So let's look at how that works as our final journal entry. So we've got our first 2, that's the actual payroll. Now we're going to go to where we pay off our debt, or at least some of the debt in this case. We're going to look at what happens when it's time to pay, and we're going to do these 3 go together. Usually when you pay it, you pay them all at the same time, and we'll see that later on in this semester. We're going to pay federal withholdings, Social Security, and Medicare. So what we need to do is we need to go back up and look at, all right, our first one. If we're going to pay it off, I need to know how much I owe. I owe $124. So if I'm going to pay it off, that's going to be, that 124 has got to be put over here in this little pot, and then I'm going to write one big check. Or I could write 3 checks if I really had to, but that's silly. Might as well just write 1 check to pay them all off. It tells us here we are somewhere in the future, 2 weeks to a month after. So let's say we were at the end of March, 3/31. It's time for me to pay off this 124. When I pay it off, I want to owe nothing. So right now I've added these 2 amounts. So if I come over here and I'm going to pay it off, I want to put whatever I owe that I'm going to pay over here in the debit side as a subtraction. And that's going to take it away that I now owe 0 when I pay it. So that's going to be my first journal entry. I'm going to debit my Social Security payable for $124. And that 124, I tried to put it here, is where I got it, the 62 and the 62. Now my balance should be 0. We're going to do the same thing for the Medicare tax. On 3/31, when I make the payment, I'm going to see how much I owe and then put it in here. That's $29, and that shows me nothing is left. Medicare payable, I debited 29, so I put that over here in my journal entry. We're going to do the same thing, one final for federal income tax. Federal income tax is only paid by the employee. So we only have one amount. So on 331, I see that I owe 50. So I'm going to put in here that I pay off 50 to get me to 0. And I'm going to do that in my journal entry as well. Now I pay all of these together. You can pay them all to the same place. All I've got to do is just add up, what is my check going to be? Instead of writing 3 checks, which would be silly. And you do this mainly online now as well. You actually pay it with a credit card or through their automated system with your withdrawal from your bank account. You add them all up and it's going to say, all right, you owe us $203. So we're going to show that we had to pay $203. We come over here to our cash on 331 and put in $203 of cash. Our cash is going down. We don't have that cash anymore. Now, if we're all done and we've done it correctly, this should also equal the right side. So 39.75 does match 39.75. I've put them in correctly. Okay. I think let's see here. We got one more item, the trial balance. And we'll take a break here and we'll start actually a new video. We'll call this video part 1. And we'll start the trial balance, kind of give you a little break, chance to let this set in. And we'll move into module 1, part 2, the trial balance.